I think on the long-term asset allocation perspective, so when you're thinking about the next 3 to 5 years, the U.S. outperformance is over. And we really saw that in January and February. Again, before the trade tensions took everyone's attention, Europe in particular was outperforming, so was China. Dollar peaked well before Liberation Day on April 2nd. So I think that there might be a temporary kind of reset, reflow, especially as S&P 500 prints a couple of more green days, especially as some of the other risks are taken off the table, whether it's financial transaction tax, whether it's firing Jay Powell. Those are all going to produce a sigh of relief rally for American assets. But I think that the growth engine of America that really allowed U.S. to outperform and created this perception of exceptionalism, which is fiscal policy, that's permanently severed, if you will. And so really what investors have to think about is the second derivative of the trade war, the second derivative of the U.S. administration being mean to the rest of the world. And that second derivative is fiscal stimulus in Europe. It's probably support for consumption in China. And that will rebalance growth away from the U.S. to other large economies.
You don't think this COVID era kind of market behavior will come back? What would be, just to challenge you on that front, what would be some of the risk to your base case scenario that the U.S. bull market is perhaps over for now?
Well, just to be clear, I mean, U.S. will still do well. I mean, if the whole world is in a bull market, it's not like S&P 500 is not going to be. We're really talking about performance. We're talking about relative performance. But to answer your question, how would the U.S. continue to outperform on the upside? And I think there's really two scenarios. One is a significant geopolitical risk, such as what we saw in 2022 when Russia invaded Ukraine. Something like that would create a safe haven flow back into U.S. assets, which are seen still as a safe haven. The other one is some sort of a endogenous technological revolution that's very specific and America-based. So AI does not fit that bill. Why? America is sharing AI with the rest of the world. We saw DeepSeek, obviously. It's not like a healthcare company in Spain or a financial company in South Korea cannot use AI to improve their profit margin. But if there was something more endemic to the U.S., for example, like the shale revolution, maybe that would allow U.S. markets to continue to outperform. But investors just got to realize U.S. was expensive in 2024 at historical levels. So was the U.S. dollar. This declining performance of America relative to the rest of the world, quite frankly, is healthy for the rest of the world and for the U.S. And in a way, it allows the Trump administration to claim victory, because if you think about currency depreciation, it's sort of like a gentleman's tariff, if I can use that, expression. It's a way to impose on the rest of the world an across-the-board tariff, but with the assumption that eventually the dollar will appreciate at some point 3 to 4 years from now. And so the U.S. gets the next 2 to 3 years to competitively devalue, get a little boost to its exports and manufacturing, rebalance its trade imbalance through a natural macro mechanism. And I think that leaves everyone happier in a way.